Hello everyone, welcome to Option Gig. This is your host Vivek Somani. I am an option trader by passion and a full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your day job, then join me in this journey. Alright, so today the topic for discussion is trade exit checklist. In another video earlier we had discussed trade entry checklist, means what we should look for before we enter a trade. Now we're gonna look at what are the things that we're gonna take care of when we plan to exit the trade and when to actively look at exiting a trade. Alright, so let's get started with it. So first question is, why actively exit trade or actively manage trade? Why not let the trade go through the full option period and expire at the end of expiration period? That is because if we let the trade go all the way to expiration, it increases the volatility multi-fold. And when I talk about volatility, means the volatility of our portfolio value. And we'll get into a detail of why it happens if we let the option trades go all the way to expiration. We have also seen that managing trades or actively managing trade increases our probability of profit. So generally when we enter the trade, we enter at 70% probability of profit. But if we actively manage the trade, we could increase the probability of profit to be 80 or 85%. So we should always have an exit plan ready when you're setting up a trade. So when you enter a trade at that point of a time, you should have a plan on when you will be able to exit the trade. Okay. So we will review the various aspects of exiting the trades in next few slides. So this is our exit checklist. So we look at managing or exiting the trades based on a profit or lack of profit. We don't always make profits. Our probability of profit is 70%. So there are 30% cases where the trades will go wrong. No doubt about it. So one is, how do we manage based on the profits or the loss? So it could be managing winners if a trade is making profit, or it could be managing losers. Now in both the cases, our trade management is based on the specific targets. We'll get into the details. Or we could also manage based on the time, in terms of what's the right point when we start to manage the trade, which is based on how much time period has already expired and how many days are remaining before the contract will expire. So that is called managing based on time, means remaining days to expiration, remaining DTE. So first let's look at managing based on the profits. So this is how you should manage the trade based on the profit target for undefined risk trades. When I say undefined risk trades, means those are naked trades, naked call, naked puts, strangle, straddle, or any variation of it which does not have a long leg to cap the losses. So theoretically the losses are undefined. So for a different type of strategies, the profit targets should be different. For example, for naked calls and puts and strangles, your profit target should be 50%. Means if your option trade, if your naked call or naked put is making 50% of the max profit possible, then you should exit the trade. In case of a straddle, the profit target is 25%. That means if your straddle trade is now making 25% of the initial credit received, then you should exit the trade. Now we will look into the examples of each one of them. So before we get into the example, let's look at what is the loss in case if the stop. So in case if the option trade has not gone in the direction where we wanted it to go and is making losses, then how long should you wait before you exit the trade you should wait. Your loss exit target should be 3 times the initial credit received. Do not close your trade immediately once the trade goes into a loss zone. Um, because we will see that many times trades comes back into profit zone. So you should wait for until the value of a loss is twice the initial credit, means the option value, the value of the option contract is 3 times the initial credit received. Alright, so this is an example of a naked put when it is making profit. So if you really look at, that's the opening trade of Alibaba, in which we sold 165 put expiring on 18th April 2019. This was sold for $3. So this is a naked put. So the profit target is 50%. So what should we do? We should buy back the put when the price of the option reaches $1.50, and it could reach any time during your option period. Let's say if you put an option trade today, if in next 5 days it reaches this target, we should exit the trade and recycle the capital into some other trade. Do not wait till the expiration period, or do not wait to capture all the $3 in profit. So the best way to avoid your emotions getting into it and to do it mechanically is, once your opening trade goes through, you should immediately set a good to close order with your limit, which makes your profit equal to 50%. So in this particular case, once my initial opening trade has gone through, I would go and immediately set a good to close order for Baba to buy back 165 put at $1.50, because the profit would be initial credit received is $3. I'm buying back it in $1.50, so the profit is $1.50, which is 50% of the original credit of $3. If you put a GTC order or good to close order, you will take your emotions out of it. You don't have to babysit this order. Whenever this option, naked put option reaches $1.50, the order will get executed and you will capture the profit. Next, we will look at the naked put, but which is making loss. It is not in a profitable zone. Same, if it was the same opening trade, and let's say instead of the stock going up as we would have wanted, it is going down, that means the trade is going against us. So then you should buy the put back when the price of the option is $9. That means you are limiting your loss to the twice of the initial credit received. Your initial credit was $3. You bought back the put in $9, means your loss is twice, which is $600, which is twice the initial credit received. Okay. Now let's take an example of a straddle. So in case of a straddle, our profit target should be 25%. So let's say this is a straddle of XLU, a utilities ETF of at 54 call and 54 put, and we initially sold it at $2.40. So since this is a straddle, the profit target is 25%, means you should buy the straddle back when the price of the straddle reaches $1.80. So when you buy back at $1.80, your profit is $2.40 minus $1.80, which is equal to 60 cents, means 25% of the initial credit of $2.40. Now these profit targets have been arrived at after extensive research and by looking into the thousands and the millions of trades over a few decades. So these numbers do really work. Alright, let's look at another case on how to manage the defined risk trades. So in the previous cases we looked at naked put, naked call, straddle and strangle. All are undefined risk. In this one we're going to look at the defined risk trade, means put credit spread, call credit spread, iron condors, and iron butterfly. So for the defined risk trade, again, our profit target should be 50% for call, put, and iron condors, and it should be 25% for iron butterfly. For example, now this is an example of a put spread. So instead of us selling $165 naked put like we had seen in the previous one, this is a put spread of $165 is a short leg and 155 is a long leg. So this is a put spread of a width $10. So in this case, we have sold this put spread with the initial credit of $1. So this is a defined risk trade. So the profit target is 50%. Means we should buy the put spread back when the value reaches 50 cents. Because so you should set up a good to close order like this. Means buying a vertical spread or a put spread of BABA, and this is the put spread. You should buy it back when it becomes 50 cents. So if it is 50 cents, means your profit is $1 of initial credit minus 50 cents, which is profit is 50 cents, means 50% of the original credit of $1. I hope this makes sense. Let's look at how about the loss. So interestingly, we should not manage if a trade is making loss if it is a defined risk trade. And this goes very contrary to a common person belief is why we should not make actively manage the losing trades. It is because we already know what risk on this trade is. We were comfortable in taking that risk. Now we should let the probabilities work out. If you're not comfortable in taking the loss of the defined risk trade, then you should not have opened the trade in the first place itself. Looks like the trade was too big to begin with. Okay, so for a defined risk trade, do not actively manage, let it go through expiration. You already know what your maximum loss is and your portfolio can already handle it. So let the probabilities work themselves out and don't manage the losses in the defined risk trade. So these we looked at based on the profit or the loss. Now we will look at how to exit or manage the trades based on time. That means how much time is remaining in the contract. So the ideal time to start exiting or managing the trades is 21 days to expiration. What I mean by this is, let's say you have a put spread and it has not yet making 50% of your maximum possible profit, but now we are reaching close to 21 days to expiration. So whatever profit it is making, maybe it is making only 10% of max, maybe it is making only 15% of max. So whatever it is making, you should close the trade and recycle the capital. That is what I mean by managing the trades at 21 days to expiration. Why? We want to manage before 21 days to expiration because the gamma, that's a option Greek, the gamma becomes higher and higher closer to expiration, which means then even a small move in the stock price will see a large moves in your portfolio P&L. So to reduce the volatility of the P&L, we want to manage it before 21 days to expiration. So in the trader lingo, we call it, avoid getting burned by gamma rays in the last couple of weeks of expiration. It is best to get out of a trade and not remain, in that period. All right. So what are the benefits? So if you manage winners sooner, then you get higher probability of profit. Like I had mentioned earlier, when we initially open a trade, we look at the probability of profit of 70%. But if you actively manage your winners, you could increase the probability of profit to be 80 to 85%. And also it will give you predictable P&L because you know that you will be exiting the trade at 50%. How about managing early? at 21 days to expiration, it will reduce the volatility in the returns because we are not exposed to the vagaries of gamma Greek in the last few weeks of option trade. And also it gives a predictable duration when the profits will come in. So these are the benefits of managing winners and managing early. Now the question is, does this really work, right? Does managing the profits at 50% or managing the trade at 21 days to expiration, does it really work? Do we have proof of it? So here we come. Again, this is not my research. The research has been done by tastytrade.com. So this is a SPY delta of 16 delta SPY Strangle. These are the trades which have been put at 45 days to expiration. So now if you really look at, if these trades will let them expire, your graph or a portfolio P&L is shown by this gray color. So which means if for over last 12 years from 2005 to 2017, if you had added 16 delta strangles 45 days to expiration and let the trade go through full expiry, your portfolio value is here. But if you had managed at 21 days to expiration, your portfolio will be here. So see how much more beneficial it is to manage at 21 days to expiration than at letting it go through the full expiry period. But if you had managed at 50% winner, then your portfolio would have landed here. Now let's look at a combination. Use a combination of, if a profit target is received or achieved prior to 21 days to expiration, we exit the trade. Or if the profit target is not achieved but it is 21 days to expiration, we still exit the trade, which is a combo of profit target plus days to expiration strategy. How the results will look like, let's look at that. So the light orange line which you see is the combo. Green line you see is a 50%, managing at 50% of profit target. The blue line, which is this, is managing early, means managing at 21 days to expiration. And this is a don't manage a trade but let it run all through the expiry. So letting your option trades run all through the expiry is worst. The combination works out the best. So there is no reason for us to put the trades and then forget about it and let it run through expiry. Whenever we put a trade, we should always go ahead and put a good to close order at 50% of the profit target. But if that order does not get executed and it is 21 days to expiration already, then we should actively manage the trade. Now what to be done in 21 days to expiration is probably a subject of another video in terms of how do you adjust your trade if it is not making profits, or if it is making profit, then you simply should close the trade and exit the trade. Alright, so takeaways from today's session. Managing winners early and recycling capital is the key to increase your the overall portfolio profitability. Start managing or exiting the trades at 21 days to expiration. Like we have seen that the combo of both of them works best and gives us the best result. The combination of managing the winners at 50% or 25%, whatever the profit target is, and managing early gives us the best of both worlds. Managing losers at 21 days to expiration or putting a stop loss at 3x, whichever is earlier, is again gives us the best results for our portfolio profitability. I hope you find this session useful. Thank you for your time. But in case if you have any questions or comments, add it in the comment section or send me an email at optiongig@gmail.com. If you liked what you learned, help me spread the word so others can also benefit from it. And don't forget to subscribe to this YouTube channel.